So what is cash? Cash is money or any other negotiable instrument that is readily available for unrestricted use. Okay, so your cash, therefore, is composed of at least two items. It is money and it is negotiable instrument. But there is a qualifying phrase in this definition. That is, it is readily available for unrestricted use. Before we go and discuss regarding money and negotiable instrument, we must first define what does your readily available for unrestricted use means. When we say it is readily available for unrestricted use, the money or negotiable instrument must be for immediate deposit or credit. Immediate deposit or credit, or it means that it is without restriction and is usable for the current operations. Okay, so when we say that your cash is readily available for unrestricted use, the first thing that we need to look is it immediate? It is readily available for immediate deposit or credit. So for example, you have your money, you have your check, and in case you are to deposit it, will the bank honor that money? If yes, then it is readily available for immediate deposit and credit. Next is it is without restriction and is usable for current operations. When we say without restriction, we look for legal restrictions. Legal restrictions. So when we say legal restrictions, these may arise based on law or based on your contract. So for example, under the law, your bank account was frozen. So that is a legal restriction under the law. And under the contract, so for example, you are a depositor with a bank and you entered with the bank a contract of loan, and under that contract of loan, your deposit in that bank will be restricted. So that is a restriction based on contract. Next, it is usable for current operations. So when we say it is readily available for unrestricted use, it must be always available for current operations. So it must fund our current operations. Now we are done defining what is readily available for unrestricted use mean. We can now go to the items of cash, that is your money and negotiable instrument. Okay, so start first with money. So when we talk about money, money is cash in layman's term. Money is cash in layman's term. And your money can either be peso or a foreign currency. Peso or a foreign currency. So if ever your money is a peso, if your money is a peso, therefore, you should measure it at Philippine peso. If your money is a foreign currency, you should measure it at the current exchange rate. Current exchange rate. Okay, so under your foreign currency, there are two dates for measurement. So the first date of measurement is the date of transaction. Second is your date of reporting. So on the date of transaction, that is the time that you have collected or you have a foreign currency. So for example, for today, you sold to a US company and the US company paid you $30,000. So today is the transaction date of that $30,000 or that foreign currency. How about your date of reporting? Your date of reporting is the date of your financial statements. So this is your financial statement date. So for example, you are using a calendar year, and the calendar year ends at December 31. Therefore, your date of reporting is December 31. Okay? So the FS date, or date of reporting. Okay, so again, your foreign currency can and should be always translated at the current exchange rate at the date of transaction and at the date of reporting. Subsequently, at the date of reporting. So initially at date of transaction, subsequently at the date of reporting. So for example, sold 5,000 bags worth $3,000. Sold 5,000 bags worth $3,000 on January 10, 2020. Date, FSD is January 31, 2020. And then the following are your current exchange rates. So you are given January 10, $1. $1 is equal to 50 pesos. January 15, $1 is equal to 52 pesos. January 31, $1 is equal to 53. Okay? So if ever you are given that scenario, here you have received $3,000. You have received $3,000 cash. So how should you measure it? At the date of transaction, you measure it at the current exchange rate, which is 50 pesos per dollar. And you will only remeasure it at the date of reporting, which is on January 31 at 53 pesos per dollar. Okay, now your question maybe is, sir, what happens to the changes in the foreign currency? The changes in your foreign currency should be presented as gain or loss in profit or loss. But that is another topic. However, what we need to learn here only under your cash is, of course, when do we measure your foreign currency at current exchange rate? That is the date of transaction and the financial statement date. Date of transaction and the financial statement date. So here, January 31 is the financial statement date. We measure the cash at the current exchange rate on that financial statement date. Now, after knowing your two types of cash, whether it is peso or foreign currency, your money can also be a cash on hand, and a cash in bank. Cash on hand and a cash in bank. So your money can either be cash on hand or cash in bank. Take note, peso and foreign currency are only used into the measurement of your money. Now we have here your money, which is on cash on hand, and money, which is in cash on bank. Now we start first with cash on hand. What are your cash on hand? Cash on hands are your money on hand, or those money in the entity's premises, in your cashier registers, those are cash on hand. While cash in bank is money deposited in bank. Money deposited in bank. Now for cash on hand, we do not have a problem. Because your cash on hand, the money here is the currencies and coins. And generally, these currencies and coins are in Philippine peso. So whatever is the face value of your currencies and coins, that is the value of your money or your cash on hand. Okay, so that is the face value of the currencies and coins. That is your cash on hand or cash itself. Now take note, under your face value of currencies and coins, we do not adjust it for any inflation or deflation based on your monetary unit assumption. So under your monetary unit assumption, whatever is the face value of our currencies and coins, whether the value increase or decrease as to its purchasing power. So sir, what do we mean by money which has an increase or decrease based on purchasing power? So for example, 1 peso before can purchase 3 candies. 1 peso can purchase 3 candies. However, now 1 peso can only purchase 1 candy. Therefore, the purchasing power of peso decreased. So before it can purchase 3 candies, now it can only purchase 1 candy. However, the face value remains the same, 1 peso. So even if the purchasing power increase or decrease, or whether there is an inflation or deflation, we do not account for the changes in the purchasing power of peso. Whatever is the face value of the peso, that will be the amount of our currencies and coins. This is due to your monetary unit assumption, which tells you that peso is stable, or the stability of peso. Further, the quantifiability of peso, which means whatever is the face amount of the peso, that is the amount of our cash on hand, or that is our money. Okay, so again, cash on hand, these are your monies in form of currencies and coins. And whatever is the face value of these monies will be part of our cash on hand. We go now into your cash in bank. So what is cash in bank? Cash in bank is money deposited in the bank. Money deposited in the bank. Okay, so under your cash in bank, whatever is the value of your cash in bank, so whatever is the value or the ending balance of your cash in bank, that is the amount of your cash. That is the amount of your cash. However, there are certain items that you need to take note in a cash in bank. The first item is a closed bank. Closed bank. So what if we have a money in a closed bank? What happens? Okay, so we measure your closed bank again. General rule, not part of cash. Not part of cash. It will be part of your non-current receivable at realizable value. At realizable value. However, if you can collect within 12 months, then present it as part of your current receivable. And what is the realizable value on your closed bank? That is based on the liquidation value of the assets of the closed bank. So normally, when the bank will close, it will undergo liquidation. And after the liquidation, you can collect your sums into the bank based on your claims. However, have you ever went to a bank and have you seen this particular poster at the door of the bank in which it is posted PDIC insured up to 500,000 pesos? Okay, so what is the use of that PDIC insured? So in case a bank will close due to bankruptcy or whatnot, you can collect up to 500,000 pesos first. So for example, you have a 300,000 peso deposit in that bank. Now, PDIC insures your 300,000 peso deposit fully. Why? Because PDIC has a 500,000 coverage of your insurance as to your deposits. Therefore, the whole 300,000 will still be paid to you. However, what happens if you have a deposit more than 500,000? So let's say your deposit in the bank is 1 million pesos. So PDIC insured 500,000, makukuha mo yon. However, yung 500,000 excess, anong mangyayari? Kailangan mo pang antayin na mag-liquidate si bank. So, kung kayang bayaran within 12 months, edi current receivable. Kung hindi, it will be non-current receivable. Whatever the presentation, whether current or non-current, take note, a closed bank is a receivable. Money in a closed bank is a receivable and should be measured at realizable value. Sir, what will happen to the difference between the amount of our cash and the realizable value of our receivable? It will be treated as a loss. Okay? So that is for our closed bank or bank that is bankrupt. So closed bank or bank that is bankrupt. Next issue under your closed bank, under your bank is your compensating balances on bank. Compensating balances in bank. So you have a cash in bank and you have a compensating balances. So what are these compensating balances? You have learned this one in your financial management. These compensating balances are a an amount that is withheld by the bank, not readily available for the entity, not readily available for the entity. So it is withheld by the bank. You cannot withdraw it. However, under our financial accounting, we look as to that compensating balances. We look as to that compensating balances. So is the compensating balance supporting a short-term loan or a long-term loan? Is our compensating balance supporting a short-term loan or our long-term loan? If the compensating balance supports a short-term loan, check whether it is restricted or not restricted. If it is restricted, not part of cash. If it is restricted, not part of cash. If it is not restricted and the compensating balance is a short-term loan, it is not restricted, therefore part of cash. But if the compensating balance is for a long-term loan, always, always not part of cash. So when is your compensating balance part of cash? Only when the compensating balance is for a short-term loan. Therefore, that compensating balance, which is not restricted, will be part of cash. But if restricted, not part of cash. Take note of this. But our rule is, if the compensating balance is silent, it is part of, not part of cash. It is not part of cash. Why? Because normally compensating balances are placed into the account of a debtor based on the loan type amount. Loan type and amount. So normally, the loan type is a long-term loan. That's why parang may security na compensating balance. Ano bang ginagawa nila minsan sa compensating balance? Ginagamit nila yon as payment over the interest, payment over the principal, etc. Or normally, that is your minimum amount to place or minimum amount that will stay into the bank or into your deposit. So that's for compensating balances. Take note, compensating balances for short-term loan, which is not restricted cash. So meaning you have the compensating balances to support a short-term loan. However, under your contract, it is not restricted as to withdrawal. Therefore, you can withdraw the money. It means that you can immediately make use of the money, therefore part of cash. Pag restricted kasi yan, even short-term loan, ibig sabihin yan, may compensating balance ka para sa short-term loan, pero hindi mo pa rin siya pwedeng gamitin kasi nga restricted siya. Therefore, it does not form part the definition of our cash, in which we said cash should be defined as a money readily available for immediate use. If it's restricted, it is not readily available for immediate use. Okay? So that's for compensating balances. I hope we are clear as to your compensating balances. Third issue under your cash in bank is your bank overdraft. Bank overdraft, or you overdrawn your bank account. So what happens in a bank overdraft? Bank overdraft is not really happening now. Not really happening now in the Philippines because you cannot really withdraw as much or more than your balance in the bank. So if ever your deposit is 50,000, you cannot withdraw 55,000. So what is the concept of bank overdraft? Bank overdraft happens if your withdrawals in the bank, withdrawals, is greater than your deposit. Draft means withdraw. Draft means withdraw. So, you over-withdrawn. Over-withdrawn. Kaya nga, your withdrawals is greater than your deposit. Over-withdrawal. Okay. So, take note, guys, if you are a depositor in a bank, if you are a depositor in the bank, you have an asset. We call that as cash. Have an asset, you call that as cash. The bank has a liability, that is the deposit liability. Deposit liability, that is the amount of the deposit of the depositor. Now, what happens to the bank if in case the liability is positive? Liability is positive, meaning ang mangyayari kasi sa bank overdraft, ito dapat ang normal balance na ay debit, di ba? Kasi cash yan. Yung liability mo, ang normal balance niya ay credit. However, if it's overdraft, it means that your cash has a balance of credit and the liability has a balance of debit. So there will be now a shifting of the characters of the depositor and the bank. Why? Because the bank now has a receivable over the depositor and the depositor has a payable over the bank. So there will be a shifting. The bank now has a receivable over the depositor and the depositor has a payable over the bank. So instead of having cash, you have a payable. That's why, guys, they say that bank overdraft is part of your current liability. It's part of your current liability. That is the general rule. It is part of your current liability. The exception on that rule is, first, if you have money or cash in bank in the same bank with a positive balance. Next is that if the overdraft is immaterial. So what happens here if we have these exceptions? If the exceptions are present, you will net over the cash balance. You will net it over the cash balance. Okay. So bank overdraft, general rule, you present it as part of your current liability. The exception to the rule is that you can net it over the cash balance if you have a money or a cash in bank in the same bank with a positive balance or the overdraft is immaterial. Take note, only when the overdraft is immaterial that you can net it. You cannot assume that the money is immaterial because take note, materiality threshold is variable among different entities. It means that 10,000 may be immaterial to one entity and 50,000 is immaterial to another entity. Therefore, their threshold are not the same. Hence, if you are solving a problem, wag ninyong i-assume na yung overdraft is immaterial agad. Kailangan sabihin ng problem na overdraft is immaterial. If not, then it is current liability. Sir, what if there is a money or cash in bank in the same bank with a positive balance? You net it over the cash balance. You net it over the cash balance with a positive balance. Okay, let's have an example regarding your bank overdraft. So number one example, PNB, BPI. Okay, so you have here PNB of 10,000, BPI of 50,000. Question, how much is your cash? How much is your current liability? Okay, so we have a bank overdraft over PNB. Next question, is there a money or a cash in bank in the same bank, which is PNB with a positive balance? None. Is the overdraft immaterial? None. Therefore, the 10,000 in the PNB is a current liability. How about the PPI? Since it is still a positive balance or it has a positive balance, you place it as part of your cash. Okay. Next example, number two. So PNB 1, 10,000. BPI, 50,000. Overdraft is immaterial. Overdraft is immaterial. So how much should be presented as cash and current liability? As part of your cash, we have here PNB and BPI. Why? Because the overdraft is immaterial. You net it. Net. So the net is 40,000. Current liability is 0. Sorry. Number 3. So we have here PNB 1, 10,000. PNB 2, 40,000, BPI 50,000. Okay, so cash and current liability. So the first question, there is already a bank overdraft. Can you net it over cash? Is there a cash in bank in the same bank with positive balance? Yes, in PNB too. Therefore, you can net these items. You can net these items. So 30,000 plus 50, 80,000. Current liability, 0. Current liability, 0. How about if it is in this way? Number 4, we have here PNB 1 and PNB 2. PNB has negative 10,000, PNB2 has 5,000, and BPI has 50,000. Okay, how much is the cash? How much is the current liability? So first question, is there a money or a cash in bank in the same bank with a positive balance? Our answer is yes. However, it is not enough. Therefore, you can only net here up to 5,000. So meron pa ring negative 5,000 dyan. So how much is our cash? 50,000. Current liability, the 5,000 negative. Why? Because the positive balance cannot cover the whole overdraft over PNB 1. So you can only net up to the amount of the positive balance. Okay? You can only net up to the amount of the positive balance. So I hope you understand the concept of your bank overdraft under the following circumstances and how should we treat them. Okay? So we're done discussing regarding your money. We go now to the items of your negotiable instruments. We go now to the items of your negotiable instruments. So take note under our definition that negotiable instrument must be readily available for unrestricted use. For unrestricted use. So since it is readily available for unrestricted use, we can place it as part of your cash. We only have one negotiable instrument that is readily available for unrestricted use, and that is in the form of checks. Okay. So under our checks, we need to check whether, of course, that check is readily available for unrestricted use. So again, it must be readily available for immediate deposit and credit. So pagka prinesent ko dapat tong cheque na to sa bangko, kailangan pwede na siyang i-deposit agad. Sir, paano pagka prinesent ko siya sa bangko tapos hindi tinatanggap kasi hindi siya available for deposit? Ibig sabihin, that is not part of your cash. Because take note, it must be readily available for unrestricted use. Anytime you can make use of it. Even if you can already present it in the bank, then we can say it is readily available. Okay, so for our negotiable instrument that is in the form of checks, we have only some issues as to your checks. We only have some issues regarding your check. So first, we have your stale check. We have your post-dated check. We also have your antedated check. We have your NSF check and undelivered check. Okay, so what is a stale check? A stale check is an expired check. So why do we say it's an expired check? Because you can only encash a check within 6 months from the date of its issue or from the date presented on the check. So if ever you can see a check, di ba, nandyan, pay to, dyan yung pangalan mo. Tapos, let's say, andito yung signature. And then, we have here a date. So, we have there your date. Now, when we say a stale check, from the date of the check up to 6 months. 6 months. So, within 6 months, you can encash the check or you can make use of the check. After 6 months, that check is already expired. That check is already expired. So that is a stale check. So normally checks only have 6 months life. So what happens now if in case I receive a stale check? then you can demand your debtor to replace the check. You can always demand the debtor to replace the check. Next, we have your postdated check. What is a postdated check? A postdated check is a check in which the date of issue does not coincide with the date of the check. The date of the check is dated at a later date. The date of the check is dated at a later date. So for example, today is 9/9/2020, 9/9/2020. Now, let's say that you place on your check 9/30/2020, 9/30/2020, so September 30, 2020. Okay, so today is 9/9, date of issue. Date of the check is 9/30. So it is dated at a later date. So, kumbaga, kung 9/9 ngayon, dapat magamit natin siya ngayong 9/9, di ba? Pero anong nakalagay dun sa date ng cheque? 9/30. So, kailan pa natin siya pwedeng gamitin? 9/30, hindi 9/9. Okay? So, you can only encash the check at the date of the check or within 6 months. So, if the date of the check is 9/30, you can start encashing 9/30 up to 6 months. Clear? Okay. Postdated check, it is dated at a later date. Next, we have your antedated check. What is an antedated check? An antedated check is a check that is dated at a former date. So, eto naman, former. So, this is the date of issue, and this is the date of the check. So, if that is a later date, our date of issue is 9/9/2020. So, let's say it was issued, the check was dated August 31, 2020. So, the check is dated before the check is dated before. So what happens here is that at the time you receive the check, of course, you can make use of it already because as early as August 31, you already have the rights over the check. As early as August 31, you have the rights over the check. Next, we have your NSF check or no sufficient fund check. No sufficient fund. Or this is known as drawn against insufficient fund. Against insufficient fund. So this is a check in which upon presentation for immediate credit or deposit, what happens is it is dishonored. Why is it dishonored by the bank? Because the check does not have sufficient fund. So therefore, the issuer of the check does not have enough money over the bank. So for example, A and B. A should be a check worth 50,000 pesos. Now, B went to the bank to deposit the check. Now, the bank will dishonor the check. Why? Because in the bank, the balance of A is only 30,000 pesos. So, there is no sufficient fund to pay the 50,000. Okay? So, the debtor here does not have enough fund in the bank. NSF check. Next, we have your undelivered check. Undelivered check is a check that is already completed in its form. However, it is not issued. So this is an unissued check. It is an unissued check. So it is already completed. So let's say nakalagay na dito yung pangalan niya, pay to J. Tamayao. The date is there already, and then it was already signed, etc. However, it was not issued to the payee. So in short, it was not given to me, J. Tamayao. So what will happen to the undelivered check? Do I have a right over that undelivered check? No, because I don't have the check on my hand. Okay? So these are the different checks that we need to look at whenever we try to compute for the balance of our cash. So we have stale, postdated, antedated, NSF, and undelivered check. And we need to determine what are the effects of these checks as to our cash received and cash paid. So guys, whenever you have check or you have checks you can either be receiving the check or you are paying a check. So check as payment. So you are paying a check. And then we have here check as receipt. Sorry, check as receipt. So we start first with a stale check. So we need to determine the initial entry made, and if there is an adjusting entry. Okay, so whenever you pay a check, what is your entry? So whenever you use check as payment, what is your entry? Diba? You will credit cash. Normally cash in bank. And then you debit either the liability if you are paying a liability or you pay the expense. So you debit liability, you credit cash whenever you pay a check. However, the check that you issued is already stale. So halimbawa, you issued the check now. After 6 months, hindi pa rin ginamit yung cheque. So anong nangyari dun sa cheque? Stale yung cheque. Question, na-decrease ba talaga yung cash mo? Yes or no? Answer, no. Why? Why hindi na-decrease yung cash mo? Kasi hindi naman ginamit nung payee. So, nung binigay mo yung cheque, dapat gamitin niya. So, ang assumption is, oy, nagamit niya na yung cheque. However, after 6 months, you are furnished, your bank statement was furnished to you and you learned that the check is already stale. So, since it is already stale, who has the right over the cash? The right over the cash will revert back to you as the one who paid the check. Why? Because it is not used by the person or by the payee. So what is your adjusting entry? Your adjusting entry whenever there is a stale check is you debit cash and you credit liability. That's why your stale check as a payment increases cash, increases liability. Okay? So that is if you issued a stale check. How about if you receive a stale check? At the time of receipt, your entry is debit cash, you credit accounts receivable or income. Okay. So assuming you furnish services into an entity and as a consideration, you receive a check. So you debit cash, you credit income. However, you misplace the check. So after 6 months, you cannot really find the check. So what will happen? Will you still place it as part of your cash? Not anymore, because the rights over the check is already expired. So you have received a stale check. The right over the check is already expired. So what happens now? Is it still part of your cash? Not anymore. Why? You do not have already a right over the check because it is already expired. So what is your adjusting entry? Your adjusting entry is to set up the accounts receivable and to credit cash. So what happens? Your cash will decrease and your accounts receivable will increase. That's why the effect of a stale check whenever you receive it is it decreases cash. Why? You do not have already the right. Okay. So again, whenever you are confronted with problems regarding checks, guys, please take note, which entity are you? Are you the payee, which means you are the receiver, or are you the payer, which means you issued the check as a payment? Okay? So ingat kayo doon. So that is for stale check. We go now to our post-dated check. Okay. So you receive, you use a post-dated check as payment. You use a post-dated check as payment. What is your initial entry? You debit a liability or expense and you credit cash. Okay. And we said a post-dated check is dated at a later date. A post-dated check is dated at a later date. Therefore, the rights over the check will only be transferred to the payee at the date of the check, at the date of the check. And now it is postdated. Question: who owns the check at the time of issuance? Is it you as the payer or is it the payee? The answer is the payer. Why? Because again, the right over the check will only be transferred to the payee at the date of the check. And since it is dated at a later date, as of now, the rights over the cash is still with you. Hence, what should we do? We need to revert back. So our adjusting entry is we debit cash, we credit liability. So what is the effect? Increase in cash, increase in liability. Okay, so you issue the postdated check. The right does not transfer to the payee until the date of the check. So as of this moment, there is no decrease in cash. So what you need to do is to revert it back. What if you have a check as a receipt? So you receive a post-dated check. You receive a post-dated check. So at the date of receipt, what is your entry? So you entered cash and then accounts receivable or income. So you make that entry. You debit cash, you credit accounts receivable or income. Question: do you have a right over the check at the time of receipt? The answer is no, because your right over the post-dated check will only vest at the time of the check, and the time of the check or the date of the check is at a later date. So as of now, you do not have a right over the check. Therefore, is there an increase in cash? No. So what should we do? As your adjusting entry, you debit accounts receivable, you credit cash. So a post-dated check received should decrease cash and increase accounts receivable. And increase accounts receivable. Okay, so that is as your post-dated check. How about an antedated check? Antedated check. So what is an antedated check? Again, it is a check that is dated at a former date. So whenever you issued a antedated check, whenever you issued an antedated check, your initial entry is debit, liability, or expense, credit, cash. Do you have an adjusting entry? No, because the check is good as payment. Check is good as payment. Why? Because the undated check is still a valid check. Undated check is still a valid check. So just take note, although undated, so long as it is not stale, it is still good check. Good check. How about if you receive a check and the check is undated check? What is your initial entry? You debit cash, you credit accounts receivable or income. And what will be your adjusting entry? Again, we said an antedated check is a good check. So at the time of receipt, that is already part of cash. Therefore, your adjusting entry, no entry, because it is a good check. Because it is a good check. Okay, so we're done discussing three types of check. We have stale, postdated, and antedated check. So we still have your NSF check and your undelivered check. So we go now to our next type of check, that is the NSF check. NSF check. So what is an NSF check again? It is a no sufficient fund check or a drawn against insufficient fund check or DAIF check. So what happens under NSF check or DAIF check is that you receive a check and you have a check. However, when it is presented in the bank, the check was dishonored due to insufficiency of fund. So initially, if you issued a check as payment and the check turns out as an NSF check, your initial entry is again debit liability or expense, and you will credit cash. And your adjusting entry, because you have issued an NSF check, the question here is, did you really pay your expense or liability? No. Why? Because when the check was presented to the bank, they said that the check that you issued as a payment is insufficient. The check you issued as a payment is is insufficient. Therefore, it means that you did not really pay. You did not really pay. Since there was no payment made, it means that your cash did not decrease, and your liability, of course, did not decrease. So what is your adjusting entry? You revert your cash and your liability. So you debit cash, you credit liability. So what is the effect? There is an increase in cash and an increase in liability. How about if you receive an NSF check? You receive an NSF check. So your initial entry at the time of receipt of your NSF check is a debit to cash, credit to accounts receivable or income. A debit to cash and a credit to accounts receivable or income. Now, upon presentation to the bank of the check, the bank dishonored the check that you have received. Sabi niya, NSF yung cheque mo or insufficient fund yung cheque mo. So, did you really receive a cash? No, because the check does not have enough funds. Therefore, what is your adjusting entry? Your adjusting entry is debit to accounts receivable and you credit cash. So there is you need to revert your AR and cash. So there is an increase in cash. There is a decrease in cash and an increase in accounts receivable. Decrease in cash and increase in accounts receivable. That is for our NSF check. Take note, you don't, even if you receive a check, it is properly dated. However, in this check, there is no fund on the account of the depositor. Therefore, it is not good as cash. Okay, and last, you have your undelivered check. So what if you have an undelivered check as payment? So an undelivered check as payment, again, is a check in which it was already completed as to its form. You have already the name of the payee, the date, it was already signed. However, it is not delivered. It is not delivered. So when we say it is not delivered, it means that it is not issued to the payee. So generally, you do not have an entry on an undelivered check. So generally, you do not have an entry on an undelivered check. Therefore, you do not make any adjusting entry because it is properly not properly accounted by not decreasing your cash. If ever your initial entry is no entry, therefore your adjusting entry is also no entry. Why? Because again, you did not even decrease your cash, and it is true that you don't need to decrease your cash in an undelivered check because you did not really give that check or issued the check. But the problem arises if there is an entry. So if ever there is an entry, your entry is debit liability or expense, credit, cash. However, you did not yet deliver it. So you made an entry already. However, you did not deliver the payment. So in short, is there a payment? Answer, no, there is no payment. So since there is no payment, there must be no decrease in your cash. So you need to make this adjusting entry. You revert the cash and you credit a liability. So it will increase your cash and it will increase your liability. It will increase your cash and it will increase your liability. That is for undelivered check in case there is an entry. Normally, problems has undelivered check in which the undelivered check was already entered into their books. So do not assume that there was no entry into your undelivered check. So you follow the rule that it increases the cash and increases the liability. Take note. Why? Because although you have already a check as a payment, it was not issued. Therefore, in short, you did not even pay cash. So you need to revert that. That is for undelivered check. How about in undelivered check received? So this is not applicable. This is not applicable. Sir, why is undelivered check received not applicable? Because guys, you will never know that you have a check not delivered. So if you are a PE, alam mo ba na may check pala na hindi pa dinideliver sa'yo? Hindi. Ang may alam lang yan, yung mag-i-issue ng cheque, which is the check as a form of payment. So if ever magbabayad ka through an undelivered check, ikaw lang may alam. Pero kung ikaw makaka-receive ng undelivered check, syempre hindi mo yan alam. Hindi mo alam na may undelivered check ka pala. Hindi mo alam na hindi pa dinideliver nung payer mo yung cheque. So, it is not applicable as to our accounting. Okay? So, that's it for our negotiable instruments. We talk about different types of check and how should we treat it in case, guys, we have this checks. Should we increase cash or should we decrease cash? I want you to understand why it increases cash or it decreases cash. I don't want you to just memorize to add this item or deduct this item. Okay, so you should know when to increase or decrease. When to increase or decrease. We start now with your cash equivalence. Cash equivalence. So, what is a cash equivalent? A cash equivalent is defined under past 7. It is defined under past 7. And the definition states that these are short-term, highly liquid investments. So short-term and highly liquid investments that is readily convertible to a known amount of cash and so near their maturity that they present insignificant risk of changes in value because of changes in interest rates. So near its maturity, that they present insignificant risk. Okay. So we have these two characteristics of a cash equivalent. Actually, I normally present it in 4 characteristics, but we present it right now into 2 characteristics first. We have your short-term and highly liquid investment. It is nearest maturity that they present insignificant risk. So we start first with this short-term and highly liquid investment. So it must be a short-term investment, meaning it must be less than or equal to 12 months. It is less than or equal to 12 months. Next, it is an investment. So when we say investment, we have 2 types of investment that can either be a debt investment or an equity investment. So that can either be a debt investment or an equity investment. Next, so near its maturity, it means it has a maturity date. It has a maturity date. Sir, what is the difference of less than 12 months to a maturity date? In a less than 12 months, it focuses more on how you will present the item, whether it is current or non-current. While if there is a maturity date, a specific maturity date, there must be a redemption date. There must be a redemption date. This is important in our investments. Take note that one requisite here is it must be near its maturity and that they present insignificant risk. Okay, so this is one element here. If you will just measure it as a short-term and highly liquid investment, then everything that is less than 12 months is part of your cash equivalent, right? However, we have here near its maturity. It means that it must have a maturity date. So we said we have 2 types of investment, debt investment and equity investment. Is debt investment with maturity date? Yes, a debt investment has a maturity date. How about an equity investment? Is an equity investment or does it bear a maturity date? No, it does not bear maturity date. Therefore, the short-term highly liquid investment that is said to be a cash equivalent only pertains to a debt investment. Sir, how about equity investment? Is there no chance that our equity investment is not part of cash equivalent? The answer is no, because an equity investment can still be recorded as a cash equivalent if that equity investment is a redeemable preference share. Redeemable preference share. Why? Because a redeemable preference share bears a specific redemption period. It bears a specific redemption period or redemption date. And this specific redemption date is the maturity date. Since it has a maturity date, it is treated more as a debt rather than equity. Okay, so again, what investment bears maturity? That investment always bears maturity. An equity investment does not bear maturity, in the exception of redeemable preference share, because redeemable preference share has a specific redemption date. And that specific redemption date is known as your maturity date. Therefore, your redeemable preference share is more treated as a debt rather than an equity investment. Okay, so that's how we will interpret short-term, highly liquid investments near its maturity. So short-term, it doesn't mean that it is current, it is a cash equivalent. You must look that must be an investment that it's near its maturity. So it means it has a maturity date. We go now to the next part of the definition. It is highly liquid and it presents insignificant risk. It is highly liquid and it presents insignificant risk. When we say highly liquid, anytime you can collect, or within a short period of time, you can collect. Within a short period of time, you can collect, you can liquidate. Short period of time you can collect. How about insignificant risk? When we say insignificant risk, the changes as to the value of the investment should not be high or should not be so variable. So normally, if ever it is highly liquid and presents an insignificant risk, the changes within that period is negligible. It is negligible. So halos hindi mo mapapansin yung changes na yan. And what is that highly liquid term in which it presents insignificant risk? So that highly liquid and insignificant risk means 3 months. So this period normally wala masyadong changes in our interest rates. Therefore, there is no risk as to the changes in the value of our investment. Okay, so it must be 3 months. Therefore, if we try to define a cash equivalent in a layman's term, or in layman's term, a cash equivalent is a debt investment or a redeemable preference share purchased 3 months before maturity. So at most, it must be 3 months. Meaning, 3 months na yung maximum natin. That is the maximum. Okay, so whenever you try to look whether the item is a cash equivalent or not, you need to determine that it must be purchased 3 months before maturity. So what do we need to look at? First, you need to check whether that is a debt investment or a redeemable preference share. If the answer here is yes, you proceed to step number 2. You check the maturity date and the purchase date. The difference between the maturity date and the purchase date must be at most 3 months. So 3 months. 3 months yung maximum natin. Okay, let's have an example. So purchase a debt investment bearing issue date of January 1, 2015. The debt investment is a 5-year investment. The investment is purchased on August 31, 2019. August 31, 2019. Okay? So, first criteria, debt investment or redeemable preference share, the answer is yes. It is a debt investment or a redeemable preference share. Next criteria, the maturity date and the purchase date must be at most 3 months. So we need to determine the maturity date and the purchase date. So what is the maturity date? So it was issued at January 1, 2015. And the debt investment is a 5-year investment. So ibig sabihin 5-year term siya. So to compute for the maturity date, that is January 1, 2015, plus 5 years. So our maturity date is January 1, 2020. Our maturity date is January 1, 2020. Now, what is the purchase date? Our purchase date is August 31, 2019. So from August 31, 2019 up to the maturity date of January 1, 2020, is it within 3 months? September, October, November, December. So this is 4 months. This is 4 months. This is 4 months. Since this is 4 months, it is not part of cash equivalent. Why? It did not meet the next criteria that it must be it has a 3-month maturity date and purchase date at most. So ibig sabihin, less than or equal to 3 months. Less than or equal to 3 months. Clear? Clear? You just need to look as to your debt investment, whether it is within the maturity date and purchase date 3-month rule. 3-month rule. Guys, by the way, if ever you will see problems like this, it is only stated as a 3-month treasury bill, 3-month treasury note. These items are considered as cash equivalent. If ever the issue date or the purchase date is not given, so you cannot really compute for the purchase date, you assume, the assumption here is that the issue date or purchase date is the first day of the security. Okay, so if that is a 3-month treasury bill, it means that you have purchased it on the first day of the 3 months. Sir, what if 120 day, not part, 180 day, not part. Why? Because the 3-month here should be 90 days. The 3-month here should be 90 days. So your max is 90 days. Sir, why? Because if ever it is month, the max will be 92 days, right? Because 31, let's say, December 31, January 31, and then February, hindi pa rin, hindi siya abot. Pwede, November, December, January, o di ba, magna 92 days yon. So, kumbaga, ang magiging max sana natin is 92 days. Sir, bakit dito 90 days lang? Because we assume that per month is 30 days. And anyway, there will be no issuer that will issue a 92-day note. Lagi nila yung i-max at i-10th day. So, pwedeng 30 days, 40 days, 50 days, 60 days. Bibihira ka makikita ng may butal na 91, 92. Okay? So, guys, take note. You must always check if ever it is within the 3-month rule. So, less than or equal to 3 months. And take note, only debt investment and redeemable preference share. So, if ever you will see a problem with ordinary share, that is already not part of cash equivalent. If you will see a problem that is a trading investment, that is not already part of the cash equivalent, because normally a trading investment is an equity or ordinary share. Just take note of this 3-month rule. And if ever, again, the problem will only provide you the days, let's say 90 days, 30 days, you assume that the issue date or the purchase date is the first day of the security. So you purchase it at the time of issuance. Okay? So I hope we're clear with cash equivalence. I hope we are clear with cash equivalence. So we're done discussing items of cash and items of cash equivalent. Last topic for our cash and cash equivalent is the items of your cash funds. Items of your cash funds. What is a cash fund? A cash fund is a cash set aside for a particular purpose. It is a cash set aside for a particular purpose. Your cash fund can either be a current cash fund or a non-current cash fund. So we say it is a current cash fund if it is for the current operations. It is for current operations. It is a non-current cash fund if it is non-current in nature. A non-current cash fund is always not part of cash. It is separately presented as a non-current asset. it is separately presented as a non-current asset. So it is a cash fund restricted for non-current use. So we have here your current cash fund, which is a current operation. Your current cash fund can either be part of cash or other current assets. So if it's part of cash, it is a cash fund set aside for current purposes. It is a cash fund set aside for current purposes. So for example, the cash fund should support a current asset or a current liability. So for example, petty cash fund, it is for current liabilities such as your petty expenses. Payroll fund, payroll is current. Therefore, it is part of cash fund that is considered as cash. How about as receivable accounts payable payment fund? So accounts payable payment fund is still current liability, therefore part of cash. Nasundan? Basta itong cash fund na to na set aside for current purposes only. That is, it support current asset and current liability. How about a current cash fund for current operations that is treated as other current asset? So these are your previous non-current cash fund that is currently maturing. That is currently maturing. Okay. So at the date of restriction of the cash fund, at the date that you set aside the cash, your journal entry, at the date you set aside the cash, your journal entry is the fund. So for example, debit payroll fund, you credit cash. Now, what happens to this payroll fund is your problem only as to the presentation. So your presentation can either be as part of cash, as part of other current assets, or as part of non-current assets. So sir, kailan uli siya magiging cash? It is purely for current asset or current liability. Sir, kailan siya magiging other current assets? If it's previously a non-current cash fund that is currently maturing. So for example, you have here a PPE retirement fund. A PPE retirement fund is a non-current fund. However, let's say today, this year is 2020, you will make use of the fund on 2021. You will make use of the fund on 2021. So it is currently maturing. You can still make use of it as a 2021. But actually, it is a non-cash fund or non-current cash fund. Since it is a non-current cash fund, it's still part of other current assets. It will not be part of cash, okay? So if ever it is currently maturing, other current assets. Sir, what is the reason why the non-current cash fund, even if it is currently maturing, it is still part of other current assets, not part of cash? The main determination is the purpose. The main determination is the purpose. If the purpose is for non-current, it will never be cash. If the purpose is non-current, it will never be cash. But if the purpose is current, it will be part of cash. So here, the initial purpose is for non-current, even if you will expend it already next year. So the initial purpose is non-current, therefore not part of cash. Clear? Okay, so cash funds can either be cash, other current asset, or non-current asset. Sir, what happens if ever it is a non-current cash fund? So let's say we have a PPE retirement fund, and then subsequently it will now become current because I will make use of it next year. What will happen? Will I make an entry? So the answer there is you will not make an entry because the problem is only a presentation. The entry is only made at the date of setting aside of cash. But at the date of presentation, so bahala ka kung ilalagay mo siya sa current, non-current. Ang akin lang, dapat alam ninyo kung kailan siya magiging cash, other current assets, non-current assets. Clear? Okay?